Welcome back to the X100% channel. I am your host, Eddie. Today, we are going to embark on a journey into the very engine room of one of the most talked about financial instruments of the last few years. We are not just scratching the surface today, we are drilling down to the bedrock. For decades, investing has been plagued by a brutal compromise. It is a compromise that every advisor tells you about and every retiree fears. It is the choice between eating well and sleeping well. If you want to eat well, you buy growth, you buy the Nasdaq. You buy the innovators, the disruptors, the companies changing the world. You buy Apple, Microsoft, Nvidia. And when times are good, you feast. Your portfolio doubles, triples, but you don't get much cash in your hand. The dividends are microscopic. You have to sell your shares to buy bread, and if the market crashes, you starve. On the other hand, if you want to sleep well, you buy income. You buy boring bonds, slow-moving utilities, or stale consumer staples. You get a check every month, sure, but you watch from the sidelines as the rest of the world gets rich on the tech boom. You lose purchasing power to inflation. You are safe, but you are stagnant. For the longest time, there was a wall between these two worlds. But recently, financial engineering has begun to crack that wall, and one specific tool has smashed right through it. We're talking about the JP Morgan Nasdaq Equity Premium Income ETF. The ticker symbol that has become a celebrity in the income investing community, JEPQ. If you are listening to this, chances are you know the name. You might even own a few shares. But do you truly understand the machine you are holding? Do you know what happens inside the black box when the market crashes? Do you know why your dividend check changes every month? Do you know the tax bill that is waiting for you? By the time we finish this episode, you will not just be an investor in JEPQ, you will be an expert on it. Let's begin with the identity of this fund. What exactly is JEPQ? Many people make the mistake of thinking JEPQ is just QQQ with a dividend. That is a dangerous oversimplification. JEPQ is an actively managed exchange-traded fund that seeks to generate current income while maintaining prospects for capital appreciation. Keyword: actively managed. Unlike the QQQ, which is run by a mindless algorithm that just buys the top 100 non-financial companies on the Nasdaq, JEPQ is run by humans. Specifically, portfolio manager Hamilton Reinert and his team at JP Morgan. They are not beholden to the index. They use the Nasdaq 100 as a benchmark, yes, but they have the freedom to make choices. The fund launched in May 2022. Think about that timing for a second. It was born right in the middle of a brutal bear market for technology stocks. It was forged in fire. And despite that rough start, it has gathered billions of dollars in assets at record speed. Why? Because it offers a solution to the volatility that terrified everyone in that bear market. So how does this machine actually work? I want you to visualize JEPQ not as one single fund, but as two distinct engines working in parallel. Engine number one is the long equity portfolio. This typically accounts for approximately 80% of the fund's assets. This is the foundation. Here, the managers are buying the actual stocks. They are buying Microsoft, Alphabet, Amazon, Meta, and Tesla. But because they are active managers, they employ a proprietary ranking system. They analyze companies based on earnings estimates, valuation, and financial strength. If they believe a certain tech giant is vastly overpriced or has deteriorating fundamentals, they can choose to own less of it than the index suggests. If they find a hidden gem, they can overweight it. This is crucial because it means you aren't just blindly riding the index. You have a team of professionals trying to optimize the quality of the stocks you own. However, if JEPQ stopped there, it would just be a regular mutual fund. The secret sauce, the reason you are listening to this, lies in engine number two. Engine number two is the options overlay. According to JP Morgan's official documentation, the fund invests up to 20% of its assets in this strategy via equity-linked notes, or ELNs. Note that these percentages, the 80% equity and 20% ELNs, are not set in stone. They can fluctuate based on market conditions and manager discretion. Now, what is an ELN? This is a term that confuses many people, so let's break it down. In a traditional covered call strategy, you own a stock and you sell a call option against it. You promise to sell your stock if it goes above a certain price. In exchange, if someone pays you cash today, that cash is the premium. JP Morgan does this, but they do it with a twist. Instead of selling options on each individual stock, which would be a logistical nightmare with hundreds of positions, they use these equity-linked notes. Think of an ELN as a sophisticated contract between JEPQ and a major bank. JEPQ gives the bank some cash. The bank then promises to pay JEPQ the return of the Nasdaq 100 index, combined with the cash generated from selling call options on that index. It wraps a complex derivative strategy into a single package. Now we need to get technical for a moment because this affects your money. What kind of options are they selling? This is the single biggest differentiator between JEPQ and some of its competitors like QYLD. Competitors often sell at-the-money options. This means if the market goes up even 1 penny, the fund captures none of that growth. They trade all future growth for maximum immediate cash. JEPQ, however, employs a dynamic options strategy. They typically sell out-of-the-money options. Let me use an analogy. Imagine you are a farmer growing apple trees. The at-the-money strategy is like selling your entire harvest in advance for a fixed price. If apple prices skyrocket next month, you don't care, you already sold them. You got your cash, but you missed the boom. JEPQ's out-of-the-money strategy is different. It is like saying, I will sell you my apples only if the price goes up to $10. If the price goes to $9, you keep your apples and you keep the growth. You only cap your upside if the price explodes past $10. The exact strike prices and option types vary based on volatility levels and the manager's view of the market. But the goal is to allow JEPQ to participate in moderate market gains. It doesn't capture 100% of the Nasdaq's growth. Maybe it catches 60 or 70% in a rising market, but that is significantly better than zero. Now let's talk about the fuel that powers this engine, volatility. You often hear people ask, is the dividend sustainable? To answer that, you have to understand that JEPQ is essentially a machine that harvests fear and uncertainty. In the options market, fear has a price. When investors are nervous, when the VIX, the volatility index, spikes, the premiums for options become very expensive. When the market is crashing or chopping sideways, JEPQ is selling these expensive options. They are collecting massive premiums. This is why, during turbulent times, you often see the dividend yield of JEPQ go up. It acts as a shock absorber. Conversely, when the market is in a euphoric bull run, slowly grinding upward every day with no fear, volatility drops. Option premiums become cheap. Consequently, the income generated by JEPQ might decrease. This leads us directly to the distribution, the dividend. You receive it monthly, but you must banish the word fixed from your vocabulary. This is not a bond, it is not a savings account, it is a variable distribution. Some months, if volatility is low, the annual yield might look like 9%. Other months, if the market is wild, it might look like 12 or 13%. You have to be comfortable with a paycheck that fluctuates. But what about the sectors? What are you actually owning? Since the benchmark is the Nasdaq 100, JEPQ is heavily concentrated in information technology. We are talking nearly 50% of the fund usually. Another large chunk is communication services, companies like Alphabet and Meta, and then consumer discretionary, Amazon and Tesla. This is an aggressive allocation. If the tech sector bursts, JEPQ will fall. The options income will cushion the blow. It acts like an airbag, but it will not stop the car from crashing. If the Nasdaq drops 20%, JEPQ might drop 15%. You are still down. Do not mistake lower volatility for no risk. Now we have to discuss the price of admission, the expense ratio. JEPQ charges 0.35% annually. In the world of ultra-cheap ETFs where you can buy the S&P 500 for 0.03%, this sounds high. It is 10 times more expensive than a passive index fund. But value is relative. You have to ask yourself, what am I getting for that fee? You are getting a team of institutional experts managing a complex portfolio of stocks. You are getting a sophisticated options overlay strategy that would be nearly impossible for you to execute alone at home. You are getting the management of the ELNs. When you compare it to the hedge funds of the past that charged 2 and 22% fees and 20% of profits, paying 0.35% for this level of active management is, frankly, a bargain. However, there is a massive hidden cost we haven't discussed yet, the tax man. This is the section where you need to pay close attention. The monthly income from JEPQ is generally not qualified dividend income. It is not taxed at the favorable capital gains rates of 15 or 20%. Because the income comes from ELNs and options premiums, the IRS consistently classifies JEPQ distributions as ordinary income. This means it is taxed at your highest marginal tax bracket. If you're a high earner, the government could be taking 35, 37, or even 40% of your dividend check before it ever hits your pocket. The tax drag can be severe. For this reason, many savvy investors hold JEPQ in a tax-advantaged account, like an IRA or a 401k. If you are holding this in a standard brokerage account, you absolutely must consult with a tax professional to see if the after-tax return makes sense for your situation. Let's pivot to the comparison that everyone wants to hear, JEPQ versus the competition. Why not just buy QYLD? QYLD has been around longer. The issue with QYLD is that it is passive and it sells at the money calls. Historically, this has led to a degradation of the share price or NAV over time. It pays a huge yield, but the principal erodes. It eats itself. Now, JEPQ aims to better preserve NAV than these traditional covered call ETFs. And looking at the data since its launch in May 2022, JEPQ has shown better NAV retention than QYLD. It has managed to capture some upside while paying out income. However, we must be nuanced here. Better preservation does not mean capital protection. JEPQ still experiences capital depreciation during severe market downturns, and we must remember the disclaimer: past performance is not indicative of future results. During the 2022 to 2023 period, JEPQ demonstrated superior retention, but this pattern may not repeat in all market environments. What about the risks? I would be doing you a disservice if I didn't outline the dangers. Risk number 1, the FOMO risk. FOMO stands for fear of missing out. In strong bull markets, even JEPQ's strategy will underperform the pure Nasdaq 100 index. Because of the options overlay, you are capping your upside. If the Nasdaq rallies 40% in a year, JEPQ might only rally 20 or 25%. You will underperform the index in a raging bull market. Psychologically, this is hard for many investors to watch. Risk number 2, counterparty risk. Remember those ELNs, they are contracts with banks. If the financial system collapses and those banks go insolvent, there is a risk to those assets. However, it is important to note how JP Morgan mitigates this. They utilize ELNs issued by only top-tier global banks, financial institutions that are rated A or better by major credit agencies. Furthermore, they spread this exposure across multiple institutions to avoid relying on a single bank. While the actual risk of default from these major institutions during normal market conditions is considered low by institutional standards, it is a non-zero risk that you need to be aware of. So where does JEPQ fit in a portfolio? It is a hybrid. It is not pure growth and it is not pure safety. It sits in the middle. It is perfect for the retiree who needs cash flow but knows they can't abandon the growth of the tech sector because people are living longer. It is perfect for the younger investor who wants to compound their money by reinvesting those massive dividends, using the income to buy more shares every single month. We have covered a massive amount of ground today, from the mechanics of ELNs to the tax implications. Before we close the book on JEPQ, let's distill this entire episode down to the absolute essentials. Here is what you need to take away. 1. JEPQ is an actively managed ETF that gives you exposure to the Nasdaq 100 technology sector while generating high monthly income. 2. It uses a dynamic strategy, allocating up to 20% of assets to ELNs, typically selling out-of-the-money call options. This allows for participation in moderate market gains, unlike older funds that cap your growth entirely. 3. The income is variable. It relies on market volatility. The rockier the market, often the higher the yield. 4. It carries an expense ratio of 0.35%. 5. Be very careful with taxes. The IRS views these distributions as ordinary income. High-income investors may see a significant portion of their returns consumed by taxes if held in a non-retirement account. And finally, 6. Past performance is not a guarantee of future results. While JEPQ has historically retained value better than its peers, it will still fluctuate with the market. JEPQ represents a modern evolution in income investing. It acknowledges that the tech sector is where the growth is, but it respects the investor's need for cash. It is not magic, it is engineering, and now you know exactly how the engine works. Thank you for spending this time with me on X 100%. Our goal is to make you the smartest person in the room when it comes to your money. If you found value in this deep dive, please do me a favor. Hit that like button so this content reaches more people. Subscribe to the channel and ring that notification bell so you never miss an episode. I am Eddie. Keep analyzing, keep learning, and I will see you in the next one.